Chapter 9, Business Income, Deductions, and Accounting Methods. So in this chapter, we're going to describe the general requirements for deducting business expenses and identify common business deductions. We're going to apply the limitations on business deductions to distinguish between deductible and non-deductible business expenses. Identify and explain special business deductions specifically permitted under the tax laws. Explain the concept of an accounting period and describe accounting periods available to businesses. And then identify and describe accounting methods available to businesses and apply cash and accrual methods to determine business income and expense deductions. So if you notice, I keep saying business, business, business. And some of these apply right across the board for all businesses. Some of them, we're really just focusing on limited liability companies with a single owner and a sole proprietorship in our course. When you are a single member LLC, so you're the only owner of the limited liability company, or you are a sole proprietorship, you file a Schedule C, trade or business income, to report the income and allowable expenses in your business. So this would include your revenue from services and sales activities, gross profit from sales. You'll be deducting cost of goods sold because that's a return of capital item. That's an expense. And a business income does not include excluded and deferred income. So we'll be discussing that. Deductions must be directly related to your business activity. And here are the three key terms the IRS looks at. Your business deductions must be ordinary to your business, necessary to conduct business, and reasonable in amount. And as we said, that's a facts and circumstance case in, I believe it was the last chapter, where we look, or even the chapter before, on compensation, where we look to see, is that something normal given the amount of income? Is that a normal type of deduction for the industry? Rick owns a business that employs his brother Ben. Right there, red flag, related party. Ben is paid $45,000 per year by Rick's business. Other employees with Ben's responsibilities are only paid $30,000. What is Rick's business deduction for employing Ben? Well, under the reasonableness amount, the $30,000 would be the amount allowed. He could pay him as much as he wants, but he can only deduct $30,000 as a business expense. The extra $15,000 is a gift. Statutory limits on business expense deductions. So some expenditures are against public policy, so they're not allowed to be deducted at all. So any kind of fines, so speeding tickets, parking tickets while you're in the business, while you're working, fines related to your business for not paying your taxes on time, or other types of fines, maybe strictly against your business, not deductible. Bribes you make. Okay, you shouldn't do that. That's against the law, but they're not deductible. You can't say, well, that's normal in my business. Well, it's not deductible. Lobby expenditures. Now, if you're not familiar with what a lobbyist is, it's basically a person, usually a lawyer, who's maybe hired by a company or an industry to influence laws. So they speak to Congress people a lot and try to influence them to vote a certain way. And I don't mean illegally influence them. I mean talk to them, to discuss the subject matter. I know in the accounting profession, we have lobbyists who go and talk to the senators and the Congress people so they understand more about what they're voting on. These people have to be paid. So any lobby expenditures you pay So capital expenditures, remember, does the expenditure provide future benefit beyond this year? So when we purchase an asset or pay for something, we ask ourselves, does it provide future benefit? Will we use it beyond a year? And if the answer is yes, we capitalize it rather than deduct it. Now, 12-month rule for prepaid expenses. We deduct if the benefit is less than or equal to 12 months, okay, and the benefits do not extend beyond the end of next tax year. So what we're saying here is, let's say on the December 1st of the current tax year, December 1st of 2017, you prepaid your insurance for the coming year. So the insurance policy will run from 12/1 of 17 through 12/1 of 18. So you have a whole year's worth of insurance there. And you paid on 12/1 of 17. Can you deduct it all? Well, according to this, if you are under the correct accounting, you can. You can deduct if the benefit is less than or equal to 12 months and the benefits do not extend beyond the end of next tax year. This insurance policy will be done by December 1st of next year. This rule, though, does not apply to the prepayment of any interest. You only are allowed to deduct actual interest as it occurs. Ben is a cash basis taxpayer, makes the following payments on June 30th of this year. $10,000 for the next 10 months of utilities. $12,000 for insurance over the next 24 months. $9,600 for the next 8 months of interest on a business loan. So these are all prepaid expenses, which would normally be capitalized. It's a deductible. Well, Ben can deduct all $10,000 for the utilities because this benefit does not exceed 12 months and the benefit ends prior to the end of next tax year. He can only deduct $3,000 for the insurance, the portion of the insurance that occurs in the current year. So the benefit exceeded 12 months. That's why it was a 2-year insurance policy he prepaid. So Ben can only deduct 6 months in this year. And Ben can deduct $7,200 for interest because the 12-month rule does not apply to interest. Special business deductions on the losses of disposition. Oops, got a tack on me. Losses on disposition of business property. We recognize losses and they are deductible. Casualty losses are limited to the lesser of the decline in value, how much it costs to repair, or how much the basis is. Basis is amount of loss if business asset is completely destroyed. So let's take a look at an example. Here's what we're saying. Let's say your business asset, your piece of equipment, caught on fire. It's completely destroyed. That's considered a casualty. So a casualty, or even if it was stolen, that would fall under this as well. And you have no insurance on it. Let's assume that for the first part. Now, what we do is we look to see how much did it cost to repair the equipment if it is in that condition that it could be repaired. And let's say it cost $10,000 to repair it. The next thing we ask is, what is the basis of the equipment? Now, basis, we normally said, was what we paid for it. But with businesses and these types of assets, it's a little more trickier than that, because you'll see when we look at cost recovery or depreciation, we record depreciation on equipment. So the basis is really the cost of the asset minus any depreciation taken on the asset. That will equal the basis. So let's say our basis in this asset is $6,000. What that second bullet is saying is you can get a casualty loss, but it's limited to the lesser of how much it costs to repair it, or the basis, what's left to expense of this asset. So in our case, it would be the $6,000. If this asset was completely destroyed in a fire or stolen, there would be no repair cost. So you would be able to deduct the basis. So the lowest amount you can deduct when it's a complete loss is how much you still have left to expense of it, or the basis, cost minus depreciation taken for taxes. Another business expense, and this will be taken on the 1040 as a deduction for adjusted gross income, is called the domestic production activities deduction. It's an artificial deduction that helps subsidize domestic manufacturing. To help encourage manufacturing in the United States, this deduction was created. And what you look at is domestic production of tangible products qualifies for this subsidy, for this deduction. But income must be allocated between qualifying and non-qualifying activities. So what this is saying is, if you are in a company that part of your revenue is from manufacturing and part of it is not from manufacturing, only the part in manufacturing would qualify. So you're actually making a product. The subsidy, so the amount of the deduction, is 9% times the lesser of your QPAI, which is your qualified production activities income, or your modified adjusted gross income as the sole owner of the company. QPAI is your domestic production gross receipts. So that's how much did you sell your manufactured products for, less expenses attributed to domestic production, and that's the key. So how much revenue did you have from your domestic production, the stuff you made in the United States, less the expenses attributed to that income made from those products made in the United States. So we look at that. So it's basically taxable income from domestic production. And so it's 9% of that, or AGI, which modified AGI, whichever is smaller, but limited, and this is that last bullet, to 50% of wages for qualified activities. So we look and say, how much of the wages were spent on domestic production? 50% of that is ultimately the limit. So if your 9% of your qualified production activities income or modified adjusted gross income is greater than 50% of wages, then you will use 50% of the wages. So let's look at an example. Brian recorded $100,000 of receipts from a qualified domestic production activity. Brian allocated $55,000 of expenses to the qualified domestic production activity, including $12,000 of wages. Brian had modified AGI of $47,000. So without going to the next slide, let's work through this. His QPAI would be the $100,000 in receipts minus the $55,000 in expenses, or $45,000. Compare that to the $47,000 of modified adjusted gross income. Now we compare those two, and the lesser is multiplied by 9%. So that would be the $45,000 times 0.09. So $4,050. That looks like his domestic production activity deduction right now, but we still need to compare that to 50% of $12,000, the wages associated with that domestic production, or 6,000. So that 4,050 is well below the 6,000, so that would be the deduction. Let's take a look. And there it is. Just as I said, we take the 100,000 minus 55,000 to get 45,000 of QPAI. Modified is only 45,000. We take the lesser of those two, so times it by 9%, and then compare that to 50% of wages. Whichever is lower is the one that will be your domestic production activities deduction. And give me 1 second. I'll tell you what line that goes on. Hold on. Sorry about that. I had to grab my book. It goes on the 1040. It is a deduction for adjusted gross income. And the DPAD, domestic production activities deduction, goes on or about line 35 of the tax return on the front. Line 35. So this does not get reported on the Schedule C. The owner would put that on their 1040. Now, business expenses with personal benefits. So there's no deduction for purely personal expenditures. Here's what we're talking about. Let's say your business decides to donate to charity. That's awesome. But that's considered that the owner withdrew the money and paid that to charity. So the owner would put that as a charitable deduction on their Schedule A, the itemized area. Same with medical, or if they gave a gift. So it's the owner is looked at as withdrawing the money and then making that as a personal expenditure. These are not deductible on the Schedule C, but maybe be deductible as personal items elsewhere on the tax return. Mixed motive. Primary motives for some expenditure, all or nothing. Business travel away from home overnight. What does this mean? Well, if you are going on a business trip and it's purely business, you're going away overnight, and away from home overnight means you're going away long enough that you need a rest. It does not mean you are away a full 24 hours. You're just long enough away that you need to sleep, you need to rest. Then you're in what we call business travel mode. Business travel mode, we are allowed to deduct expenses if they are purely business. Now, let's say you go on a trip that you spend 5 days doing business, but you're in Las Vegas, so you spend 2 days gambling. The primary motive for your trip, because you spent more than 50% of your time in business, is business related. Here's the rule. When your primary motive is business, your expenses getting to and from, whether it's plane, train, bus, is fully deductible if the travel is within the United States. If it's the other way around, you spend 2 days in business and 5 days gambling, none of the travel to or from the destination is deductible because your primary motive was personal. Now, when you are away overnight and you're on the business portion of your trip, your lodging is deductible. Incidentals are deductible, like tips. So those two items are deductible. And 50% of your meals are deductible. 50% of your meals. On the personal portion, none of the lodging, meals, or tips would be allowed. Okay, so you got to keep that in mind. Otherwise, allocate deduction to business portion, and that's what we're talking about. You must keep documents of all this. Ben paid the following to attend a business meeting in Chicago. He flew airfare, first class, it doesn't matter, hotel, meals. What amount are deductible if Ben spent 2 days in meetings? Primarily business. What amounts are deductible if Ben spent 1 day in a meeting? Well, primarily business, all of his airfare is deductible. His hotel for the 2 days that were in business are deductible. And $90 per day times 50%, or that should be $45 per day, 2 days, right? 50% of that would be deductible for the business side. The personal side, none of it's deductible. But that's how we would divide. Now, when it's primarily personal, none of the airfare. The hotel for 1 day, because he was only in business 1 day, and then, oh, that's right, I'm sorry, it is $90. I apologize. It is $90 per day. That primarily business column, 2 days is 180 times 50%. 40. The second one, though, where it's primarily personal, $90 a day, but only 50% is deductible because it's 1 day. So that's how you would determine what is the allowable business deduction. There's quite a bit of discussion, so you know, with regards to business and travel. One thing I do want to bring out to you on page, it's under the travel area. If foreign travel is primarily for personal purposes, then only expenses directly associated with the business activity are deductible. So again, if you're going on a trip to France and it's primarily personal and you're 3 days business, or I'm sorry, 3 days personal, 1 day business, nothing's deductible as far as getting to or back. But while you're in travel mode and you're doing business expenses associated with the travel within France would be. Meals are still limited to 50%. But if it's the other way, you're going to France on business for 3 days, 1 day personal. So 4 days in total, 3 days business. 3/4 of your travel to and from would be deductible. So it's not an all or nothing thing when you're traveling abroad. And they discuss that within that travel section of your Chapter 9. Also an excellent example demonstrating these rules. Another item that isn't really brought out in the PowerPoints is using your vehicle for business. So sometimes we use our personal vehicle for business purposes, or we have a business vehicle that we use for personal purposes. The question comes to mind of how much can we deduct when using our personal vehicle? And there's 2 ways to determine that. And unfortunately, I'm sorry, I don't think we have a slide on this, so I'm going to count on you to take a few notes here. The 2 ways, the first way, and we're going to write this down, is called the standard mileage rate. And I believe we've had some experience with this so far in this class. The standard mileage rate is where we take a stated rate presented by Congress, and for 2017 is 53.5 cents. We take 53.5 cents times our actual business mileage we use the car for. And we'll explain to you what business mileage is. Multiply that out, and that's how much your deduction is for using your personal vehicle. Another way to determine your expenses, and you could do these both calculations and then compare and take the greater, is to keep track of all your actual costs of running using the vehicle. Gas, oil changes, maintenance. You can take depreciation on the car. So when we talk about how to determine depreciation, know that that is included. And we keep track of it for the whole year on 100% use of the car. Well, you're not allowed to deduct all those costs because you're not using your car 100% for business. So what you do is you take the ratio of business miles that you used your car for over total miles. And it's that ratio of the total costs that would be allowed as a deduction. Now, that's a lot of record keeping, and you are required to keep track of all of that as proof. Okay, but please keep in mind you can deduct that on the Schedule C, okay, either standard mileage rate or actual costs. Now, what is business miles? That's important. Driving from your home to your tax home, which is your office, is not deductible business miles. That is called commuting. So your personal residence to your tax home, which is your normal office, your normal job, is commuting. Now, some people in business, in their own businesses, their home and their tax home are the same place. I have a brother who has that. His tax home is his home, and he paints for a living, and he has an LLC. It's a single member LLC. Whenever he leaves his home and goes to a client's to paint, that is considered business miles. Business miles. Normally, if we have an office separate from our residence, any mileage from our office to a client or a customer's and back is considered business miles. And that's generally how you could look at it right now. So they discuss that in the travel and transportation area. So you want to take a read through that. Now, we've only looked at some deductible expenses, and the ones we looked at so far are ones that are very common and the most scrutinized by the IRS, because meals are very scrutinized, and there's another component called entertainment, and that is talked about also in Chapter 9. And entertainment is a business entertainment. So you're conducting a meeting and there's some kind of entertainment involved. Maybe you took your client golfing or you took them to a show. So you're having meals, maybe a meal, and or entertainment. You took them to a baseball game right after a meeting, or during a meeting you're at a baseball game, or right after the baseball game you're having something business related. Then the costs of that times 50%. Entertainment is only 50% deductible. So the specific rules related to entertainment are also listed there. All right. Now, how do we report? How do we match income and expenses to a specific period? We talk about accounting periods. Most companies, most sole proprietors are in a full tax year, 12 months long. Sometimes, though, people ask their tax year to be changed. Let's say you're someone who, for whatever reason, your tax year has always been October 1st through September 30th, and now you want to change to a calendar year. Okay, so you file your tax return for 9/30 of 17. Because that's the end of your full 12 months. You want the calendar year 1/1/2018 through 12/31/2018 to be your new tax year. Well, there's some time between September 30th and January 1st. So from October 1st, 2017 through 12/31 of 2017, you have a short tax year. So this isn't happening all the time, but it's most common when you are changing your tax year. And that's what that means. Proprietorship is a proprietor. C corporations and individuals make a choice made on their first tax return, and they stay consistent with how they will look and complete their accounting year. Okay, flow-through entities have a required tax year. They have to match theirs. So partnerships and S corporations generally have to have the same tax year as their owners. Comparing financial and tax accounting. Financial accounting is conservative. That's your intermediate accounting. GAAP is slow to recognize income. Wait till it's earned, but quick to recognize losses or expenses. And that objective of financial accounting, we don't want to mislead anyone. Tax accounting is much less conservative. We're quick to recognize income, but of course, because they want their taxes, right? But likely to defer deductions, as we saw with prepaid expenses. The objective of Congress is different. As we said, maximize tax revenues. We got to keep that in mind. So we've talked about the different accounting methods from the income recognition, but also we need to talk about them from the deduction side. So when it comes to cash method, we recognize income when we receive it, when the cash is involved. You can also choose to be an accrual taxpayer. You recognize income when earned or receive. Hybrid is a mix of accrual and cash. Hybrid is more cash related, and that's the method that's followed, except for when it comes to accounting for inventory. You adopt your method with your first tax return. As we discussed in a prior chapter, large corporations must use accrual. Remember, cash again is recognized when income is recognized when actually or constructively received. Now on the expense side, expenses are recognized when paid. Be careful of prepaid expenses though. There's your pros and cons. It's flexible, simple, and inexpensive. You don't have to be, it's not GAAP though. So it's not matching your income and expenses, but it's just recording your cash you receive and your expenses you pay, typically. Accrual, on the other hand, is income is recognized when earned or received, and we follow what's called the all events test. We recognize income when all the events have occurred which fix the right to receive such income. So we've done our job at the company, and we have a right to receive the money, and the amount can be determined with reasonable accuracy, even if we didn't get it yet. So the earliest of these dates that we would report income is complete service or sale, payment is due, payment is received. It would be $8,000. That's the amount we could reasonably expect to get. Accrual. When it comes to prepaid income, remember these are advance payments for services, so a customer is paying us before we've done anything. We're allowed to defer recognition for 1 year unless income is earned. So when we earn it, we recognize it, except if it's a prepayment of rent or interest income. We recognize those immediately. When there's an advance payment for goods, we elect one of two methods. Inventory we're talking about here. Generally, and you'll see it on the second page of the Schedule C, the formula to determine inventory and what we sold will be your beginning inventory. So what did you start the year with? Plus all your purchases minus your ending inventory. And that will give you cost of goods sold, that expense, the cost. So how much did it cost the company for all the goods that were sold? Ben provides dancing lessons. On September 30th of this year, he receives $2,400 full payment for a 2-year service contract. What amount of income must Ben recognize? If Ben uses the cash method, he recognizes all of it. If he uses the accrual, he can elect to defer advances for services for a year. This year, Ben would recognize $300, the income earned for the last 3 months of the year. But next year, he'll recognize the remaining $2,100. He can't let that gap over into even the following tax year. And that's what they mean by that rule. Inventories must be accounted for under accrual method, and that's what I was talking about, if sales of goods constitute a material income producing factor. So we take purchases, purchases accrued with accounts payable. Okay. If you have an accrual basis taxpayer, basically if they purchase inventory that has not been paid for yet, you're going to include that. Same with sales. If they made any sales that they have not received the cash for yet, it's still included in income. Cash method taxpayers may use cash method for other non-inventory accounts. This technique is called the hybrid method. Okay, so what we're saying here is no matter if you're cash method or accrual method, you're going to follow these same rules for accounting for inventories. When it comes to inventory, we could remove inventory under one of 3 or 4 different methods, and it's up to you. First in, first out. What we're saying here is that you could assume the first items that you brought into inventory are the first ones sold. So that's how you would remove them or put them into cost of goods sold. You can do last in. That's supposed to be last in, first out. Last in, first out. And what this is saying is that the last items you purchased or the newest stuff in inventory are assumed to be sold first. So when you sell something, you'll say, what's the last thing I bought? I'm going to put that into cost of goods sold. You also have specific identification where you can say, I sold this item. I know exactly how much I paid for that. So I'm going to put that cost into cost of goods sold. And you also have average cost you can choose from. When we're accruing business expenses, we ask ourselves, did we meet the all events test and the economic performance has occurred? The all events test says this: all events in the contract have occurred to establish a liability to be paid. So we received the service, we received the utilities, we received the advertising, we received the rent, and we owe it. The amount is reasonably determined, and there's no reserves allowed to pay future liabilities. So you had to have had the service occur. The other test, the economic performance test, and this is right out of your book. Even when businesses meet the all events test, they still must clear the economic performance. Congress added this because in some situations, taxpayers claimed current deductions and delayed paying the associated expenditure for years. Thus, they got a great tax advantage there. So what the economic performance test says is that an accrual method business would not be allowed to deduct a prepaid business expense even if it qualified to do so under the 12-month rule, unless it also met the economic performance test with respect to the liability associated with the expense. Now, what does that mean? The liability arose from receiving goods or services from another party. The liability arose from the use of property. The liability arose from providing goods or services to another party, or the liability arose from certain activities creating payment liabilities. And the next couple pages explains each of those in detail with examples. So please read through them, post any kind of questions, or email me. Economic performance applies to accrual method taxpayers only. Everybody else waits till they pay, right? Taxpayers provides goods or service. Performance occurs, we're going to go through them really quick, occurs as the taxpayer provides goods or services. If the taxpayer is using property or goods, performance occurs so you could recognize the expense as goods are provided, or economic performance is otherwise expected within 3.5 months of payment. Payment liabilities are performed only when paid. So you can only recognize that as an expense when paid. You're considered economic performance. And under these circumstances, expenses related to interest and rent occur ratably over time. Let's take a look. Ben has signed a binding contract for Peter to provide Ben with repair services. Ben paid him $1,500 and owes an additional $6,000 on the contract. The repairs will commence late next year. When can Ben claim the deduction if he uses the accrual method? Well, although the all events test is satisfied, Ben can only deduct $7,500 next year because that is when economic performance occurs next year. Okay, and that's a great flow chart of how services are allowed, or I'm sorry, liability and economic performance correlates with the other code sections. When it comes to liability and economic performance, if you meet both of those, you can deduct immediately if it falls under Internal Revenue Code 162. What does that mean? Well, that's the reasonable, ordinary, and necessary. If those expenses we're talking about need to be capitalized, then some may be deductible under the 12-month rule, as we discussed. Some may need to be depreciated. And then there are certain amounts we pay under these rules that are never deductible. And one that's in this, two of them actually, that are in this flow chart are spousal travel. So if your spouse travels with you while you're on business, that is not deductible. And club dues. And what we're talking about here are country club dues. So even if you get a country club membership because of your business, the annual dues or the initiation are not deductible for tax purposes. Now, some people will go to their country club and go and have dinner with a client. Well, that dinner bill is deductible, but not the annual dues, and that's the major difference there. So you want to be aware of that. Choosing or changing an accounting method. Accounting methods are generally adopted by use. A permissible method is adopted by using and reporting it for 1 year. Okay. Generally, a method change requires the IRS permission. So if you wanted to change from cash to accrual or accrual to cash or cash to hybrid, you need to seek permission from the IRS to do that, and there are special forms. Okay, so this chapter has great information about what a sole proprietorship can, a sole proprietorship or a single member LLC, some specific items that are deductible, how they would determine if something is allowed as a deduction overall, certain things that are not allowed, choosing an accounting method, and how there are special rules with each accounting method. So please go through this really well, this chapter. I'm not sure what on your book, I have a different book in front of me, same author, but there is a profit or loss. I know there is a Schedule C completed in your textbook. Please take a look at where all those different numbers come from and how to calculate the taxable profit or loss on a business.